Good evening. Today, some tough medicine for an American economy racked by high inflation. The Federal Reserve raising a key interest rate 0.75%. It's the biggest bump up since 1994. A hike sure to be felt in the wallets of American borrowers. Think higher mortgage rates and bigger credit card payments, which we'll get into in just a moment. What's it all about? Well, the Fed hopes the increase will start putting the brakes on inflation, which is running at 40-year highs. Gas, food prices, you name it, it's all soaring. Investors like the news today. The market's rallying on the Fed announcement. Policymakers weighing future increases while trying to steer around the risk of a recession. Let's tell you what you need to know about all this, starting with Tom Costello.
For days, the Fed has telegraphed that it would go big today after acknowledging it should have acted sooner to rein in inflation. Today's 0.75 point rate hike is on top of two smaller hikes earlier this year.
We at the Fed understand the hardship that high inflation is causing. We're strongly committed to bringing inflation back down.
By raising rates and the cost of borrowing from mortgages and car loans to big business loans, the Fed hopes to cool the economy without pushing it into recession. Inflation now running at 8.6%, the highest since 1981, and Americans are getting squeezed. To make ends meet, Louisiana special ed teacher and single mom Christina Seal is now selling her plasma to earn an extra $600 a month.
It's something that I have to do in order to keep my family afloat, in order to make sure that there is enough food to go around and the lights are on and I've got gas in my gas tank.
Christina says her monthly bills have nearly doubled. A tank of gas from $40 to $90 a week. Utility bills from $180 to $300. Groceries from $150 to $300 a week. Now she's turning to a local food bank for help.
Things just kept going up. Inflation kept going up and up until my credit card was eventually maxed out.
Cereal, peanut butter.
At the Loaves and Fishes food pantry in Los Angeles, Brenda Hakimian says she no longer feels a part of the middle class.
There's either extreme rich or extreme poor, and the rest of us just kind of fall through the cracks.
Meanwhile, with nearly every American watching more of their paychecks sucked into their gas tank, the national average now $5.01 a gallon, President Biden today accused U.S. oil companies of profiting off the pain at the pump, with oil refining capacity down 3 million barrels a day since 2020. In a letter to 7 oil CEOs, Mr. Biden writes, at a time of war, refinery profit margins well above normal being passed directly onto American families are not acceptable. But the oil industry believes the Biden White House has been hostile as it tries to go green. 6 refineries have gone offline, many in need of overhaul to meet environmental standards. The oil industry says U.S. refineries today are running at or near capacity to meet demand, but still demand is outpacing supply.
And Tom, continuing supply chain problems, I know, are one of several factors the Fed says is driving this inflation.
Yeah, absolutely. And the COVID lockdowns in China not helping the supply chain. They're also watching the war in Ukraine, driving up prices and consumer demand. And they expect they will raise rates again in July, maybe by another 0.75 point. This will continue through the year. And unemployment likely to rise from historic lows to maybe even above 4% sometime in 2024, Lester.
All right. Tom Costello, thank you. Those rising interest rates, as you heard, will likely send mortgage and other rates even higher in coming weeks, pushing some people to buy now for fear of paying more later. Jolene Kent reports in our series Priced Out.
I'm so glad that we found these.
Sky Callahan was in a rush.
So financially, overall, it's been a little bit of a struggle. We had to either buy before the rates went up or completely wait.
With a growing family, she needed a bigger house. Calculating what the New Jersey family could afford depended on interest rates, which have surged. A 30-year fixed-rate mortgage climbing from 3.3% at the start of this year to 6.22% now. Home prices have been soaring, too. Median sale prices have skyrocketed 16% in the past year. The combination can mean as much as a $1,000 increase in monthly payments for families like the Callahans, a trend pushing some to act in a hurry.
When we saw that the rates were going up due to inflation, that's when we really got into gear and decided to, okay, we need to make a move now because it's only going to get worse.
That feeling Callahan was getting is called inflationary psychology, and many Americans say they've got it too, beyond the housing market. Nearly 90% of Americans are concerned about inflation, and more than a third of shoppers said they have purchased something recently for fear that the price would continue to rise.
It's our rationale that we need to stockpile things before the price increases, which just creates a self-fulfilling prophecy. As we spend more, we feel like we have less money. We blame it on inflation, when maybe it's actually our psychology.
Inflationary psychology can impact the way we spend money on everything from houses to swimsuits to baby formula, triggering even more stress and anxiety.
I feel pressured to buy now as opposed to waiting a few months because who knows what the prices are going to be then.
If you're going after a big ticket item that you really need, say a house, should you be approaching this in a certain way?
Yeah, honestly, we won't see a dramatic drop in prices after inflation stabilizes. Maybe it's time to say, instead of buying this year, maybe I can rent somewhere affordable and wait till I have more savings to buy those big ticket items.
Big ticket items whose costs seem to just keep going up. Jolene Kent, NBC News.
Of course, it's not just soaring home prices and mortgage rates. So many factors are combining into an economic picture painful for many Americans. High gas prices are contributing to the 8.6% inflation rate that shoppers are all too familiar with. Markets are down substantially. The Dow has dropped more than 16% since the start of the year, though closing up today, as we noted earlier. Meantime, household debt is rising, setting a new record this year at nearly $16 trillion. And credit card debt, that's up, reaching $841 billion, with rates expected to go up. Joining me now is CNBC senior personal finance correspondent Sharon Epperson. Sharon, what are you telling people they can do right now?
Lester, the first thing to do is don't panic. Panic is not a strategy. Focus on what you can control. With your spending, pay down credit card and other high-interest debt. By some estimates, card rates will be close to 19% by the end of the year, so you want to try to move that debt to a lower rate by switching to an interest-free balance transfer card. To boost savings, look at your subscriptions. One study says Americans spend about $133 more than they think they do on monthly subscriptions, so you want to try to cut at least one of those expenses as a way to save, or put that money toward covering the rising prices of what you need every day, like food and gas. And when it comes to investing, stay focused on your long-term goals. If you have a workplace retirement plan, a 401k or other type of plan, you are consistently putting in a set amount of money each pay period. So when markets are down, those dollars are buying more shares. And when markets recover, you've put that money to work toward what eventually could be significant growth, Lester.
A lot to talk about around the kitchen table tonight.
Absolutely.
Sharon Epperson, good to see you. Thank you.
Good to be here.